สวัสดีค่ะ Welcome all our guests. Thank you for joining our today's webinar under the topic Risky Business, Time to Diversify. My name is Ed. I'll be your host for today. And I am pleased to introduce you to our three speakers. First, Mr. Paul Gambles, Mr.
Hi.
James Fraser, and Mr. Emile de Marsac. We will come back to all of you gentlemen later on. So for today, I will be running all the agendas that this webinar will be talking about. It is widely accepted that COVID-19 pandemic was one of the most significant disruptions that many of us have experienced. These disruptions changed many of the way that we all live our life and business conduct business and that govern. Some of these changes were totally unexpected, whereas others accelerated or crystallized existing trends. But all these changes have thrown up a wide variety of challenges that all of us now have to address. Some of these challenges has been anticipated by leading experts and forecasters, but others were more difficult to foresee and many of the changes remain ongoing right now. Today, we will be talking with three leading authorities about how to address complexity within their own area of expertise, but all recognizing to varying degrees the value of diversification in order to mitigate a dangerous cocktail of known and unknown risk. MBMG Group's James Fraser will update us on cross-border reporting and the exchange of information about the financial status of individual and entities, such as companies or trusts. The dramatic take-up in such reporting and exchange was already underway before the outbreak of COVID-19, but the combination of increasing ability of government to process and transfer digital data, plus pressure on governments to enforce higher taxes in order to reduce deficit that expanded dramatically during the pandemic. More and more jurisdictions are now seen to be considering imposing or increasing taxes on wealth, property, income, or capital gains, such as the proposed minimum tax rate of 15% on large multinational companies that has been agreed to be by over 140 countries next year. James will, however, focus particularly on the measures affecting us here in Thailand and what you need to know in order to mitigate the risks that is present. Before that, Henley and partner Emile de Marsac will provide an overview on the changing landscapes in terms of global citizenship, tax residents. With the increasing cross-border exchange of information, the area of residents, tax residents, and nationalities are under increasing focus. Emile will highlight the increased risks to privacy, to asset ownership, to inheritance and succession, and to effective taxation planning, and indicate some of the potential opportunities to address these risks through an informed residence or nationality approach. Finally, we will conclude with a brief question and answer session. But of course, this is a public event, and I would like to stress that for any more personal or sensitive issues, a face-to-face discussion, which might be more suitable, is always available. You can all leave your question under the comment section here. And we will try our best to get them answered as much as possible, as many as possible. But firstly, I'd like to ask Paul Gambles of MBMG Investment Advisory to start the ball rolling for today's session by discussing changes in the investment landscape. We have seen from the volatile capital markets around the world this year that investing seems to have become something of risky business. And so we asked Paul to explain whether in this environment, diversification is still as effective and whether it remains the only free lunch. Paul is currently in England, but the day is only just starting. So I guess that I should welcome him by saying, good morning, Paul.
Hey, good morning or good afternoon to yourself and obviously everybody in Asia listening into this. For anybody who doesn't know, that's not actually me on the first slide that we're going to show. That is in fact Tom Cruise. Risky Business was Tom Cruise's breakthrough film. And it was about the entirely predictable risks, really, that he failed to foresee when he turned his parents' house into a brothel one weekend while they were away. But sadly, we haven't got Tom Cruise today. We've only got me. And we might not have nearly as much excitement, I guess, as they had making the film. But hopefully what we will do is give you a useful guide to what we think is happening in the global economy and in investment markets. As it shows on the slide there, Harry Markowitz said that diversification was a free lunch. We hope that he was right, partly because that makes our jobs a lot easier as investment advisors, but also because it proves Milton Friedman wrong. In 1975, Friedman wrote a book entitled There's No Such Thing as a Free Lunch. And usually with Milton Friedman, the title tends to be the best part of the book, and the rest of it tends to tail off pretty quickly thereafter. If we move on to the next slide, we will be showing you a quotation from what Warren Buffett regards as the investor Bible. It's basically Ben Graham and David Dodd's book, Security Analysis. And when it talks about the bull market there, it's actually talking about the bull market of 1929 and the crash of 1929, bull market of the 1920s, I guess, and the crash of 1929. But it still resonates today. So if we look at some of those key points, Graham and Dodd said that in the late stages of that bull market, the public turned its attention, investors turned their attention away from fundamentals such as dividends, asset values, average earnings, and focused entirely on earnings trend, i.e. what they expected to happen in the future. And they said that this change in focus gave rise to a theory that stocks were the most profitable, the most desirable form of long-term investment. And people kind of proved this by showing the last few years of performance. Dodd and Graham say that this kind of thinking basically has two flaws. Firstly, it ignores the distinction between investing and speculating. And secondly, it completely ignores the price of a stock or an asset as a factor in determining whether or not that's a good investment. So I guess that's the 1930s, precursor to what today we would call growth at any price. Dodd and Graham concluded that the results of such a doctrine couldn't fail to be tragic, referring to the 1929 crash. And we think the ideas that they were criticizing, or at least updated versions of those ideas, as I say, tend to prevail today, particularly in things like the ARC funds run by Cathie Wood, which claim they provide diversification because they offer exposure to 33 different stocks that Cathie Wood thought would best fulfill the half a dozen or so ideas that she sees when she looks at in a crystal ball and imagines how the world will be different in a few years' time from today. So I think the importance of that is that we underline the third weakness of this approach that Dodd and Graham implied, but they didn't make explicit, and that is that nobody can ever see the future, not even Cathie Wood, maybe particularly not Cathie Wood. Nobody knows what the future holds. Markets don't always go up. And obviously that creates a huge dilemma for investors. How can we invest for the future if we don't know what the future is going to look like? Maybe one approach is that maybe we could be smarter. If you look in the background of this chart, embedded in there is the performance of Edward Carmagnac's Patrimoine Fund, which we've held in our portfolios at various times. And this fund absolutely skyrocketed from 2009 to 2015. Edward Carmagnac famously said that he was walking through a paddy field in northern Thailand when it suddenly struck him in 2009 that this was a great time to invest in the markets. And that very much sort of typifies Carmagnac's approach, and that of a lot of other, idiosyncratic fund managers who, suddenly get these great ideas, and as long as they're right, it works out okay. Carmagnac himself famously said, there are two things that you need to be a successful fund manager. One is a big brain, and the other is big balls. Well, we know he was talking metaphorically because he made his daughter the heir and chosen successor of his investment company. But we at MBMG, we prefer to try and carefully calibrate and calculate risks. And we tend to spend most of our time focusing on managing or mitigate them. We don't want to have to rely on instincts or instinctive smartness. We don't want to rely on our brains or even our alpha hormones when we're trying to deal with something as important as investment decisions. So we, on the next slide, we try to explain what is the actual benefit of diversification. What is diversification? It's not having to know the future, not having to know the unknowable. But what really is it? So we've come up with some case studies. We were looking at this in July, and on the next slide you can see we looked at. Sorry, if we could show the next slide. Yeah, we showed what happens if you invest in a single car manufacturer. For instance, if you invest in Ford, you might be exposed to the poor performance of Ford. If you invest in 2 or 3 automotive manufacturers, then you're exposed to the risk of that sector. If you invest in them on a global basis, well, you're still exposed to the sector on a global basis. So we also look, and that's pretty obvious. I think most people would know that. But we also looked at what happens when you invest in other businesses that aren't car manufacturers, but which tend to be affected. So on that chart, we show the leading US car manufacturer in 2021, which was Toyota. They sold more cars in America than anybody else. And the leading US car retail group, CarMax. CarMax, up to the end of 2021, had increased by about 150%, whereas Toyota was only up just over half of that. But the factors that have hurt Toyota this year have also impacted CarMax to an even greater extent. So over 5 years, there's barely any difference between the two of them. So there's no real diversification benefit there. But obviously, what happens if we look at totally unrelated sectors, if we look more broadly? So we looked at the 10 most traded equity sector ETFs over the last 5 years to see, how much they tracked, how much there was any outliers. If we looked at this chart, gold miners behaved very differently in 2020. They did a lot better in 2020. They did a lot better, but still over 5 years, they end up pretty much in the middle of the pack. If we look at energy, such as oil exploration, it did much worse in 2020. But actually, over the 5 years, again, it's pretty much in the middle of the pack. This chart is perhaps a little bit busy. So if we look here, if we take out regional banks, we take out healthcare, we can see there's a really, really tight fit between equity sectors that are supposed to be as diverse as finance, consumer staples, utilities, industrials. And so it actually shows us that really there's not a great deal of diversification to be had from investing in not only different companies, but even different sectors, particularly when markets fall. The correlation between them, the fact that they all fall together, that tends to be fairly significant. So any gains that we see, any daylight that we see appearing in the chart where one might outperform, that tends to be all lost in periods of weak markets. So what does all that mean? On the next chart, we've shown I guess it's a pie chart that shows where you get the different elements of performance from within a portfolio. It's based on a 1986 paper by 3 authors called Bauer, Brinson, and Hood, and it noticed that actually the biggest factor in achieving different outcomes in investment portfolios is actually asset class selection, what we at MBMG call asset allocation. But basically, it's pretty much all down to the decision whether you should hold bonds or stocks or property or cash or derivatives or other assets. This drives over 90% of the difference between the performance of different portfolios. The next biggest, at about 4%, 5%, is stock picking, i.e. whether you did choose Ford rather than Toyota. Only a small difference is actually made by market timing, i.e. whether you buy today or whether you wait till tomorrow. So this is probably a shock to many investors who spend a lot of time agonizing over stock selection, i.e. should they buy Ford, should they buy Toyota, should they buy General Motors, or agonizing over market timing. Should they buy today, should they wait till tomorrow? It's a subject that's almost infinite in its scope and its ramifications. But we haven't got infinite time today, so I'll spare you. I'll spare you that. What we'll do is we're going to look at the importance of asset allocations in terms of the added difficulty of generating genuine diversification, because of the fact that correlations between asset classes are inconsistent over time. They tend to change, they tend to vary over time. So we're going to have a look on the chart here at the different behavior of stocks versus property at different times in the cycle. And if we look at the period of the Y2K panic, the tech wreck, stocks, i.e. the blue line, the S&P 500, they fell by around 50% from their peak. Whereas property during that time, and we've looked at the MSCI US Real Estate Investment Trust, or REIT index, which is the black line, that actually increased in value. So during that time, we saw an inverse correlation, i.e. property was a really effective diversifier against equity risk during that time. But when we got to the global financial crisis, it was a very different story. We saw that in the GFC, both of these fell almost in lockstep. So if we could look at the next chart, we see that REITs not only fell in lockstep, they actually carried on falling even when stocks began to recover. So property actually lost around 60% of its value in the GFC, which was worse than equity losses. So in this crisis, the two asset classes had become highly correlated, and therefore probably would have been a terrible diversifier. And similarly, when we get to the COVID-19 crisis of a couple of years ago, stocks and REITs, again, they fall together initially, but property continued falling after stocks began to recover, just like in the GFC. So once again, property as an investment asset was highly correlated to stocks. It provided no diversification benefits within portfolios. So that's the history lesson. Enough of the history lesson. What's actually happening today? There are many structural and causal differences between the stock market crash of 20 years ago and the three later episodes, including today's. One noticeable distinction is that in the Y2K, the tech wreck, it was really more of a kind of creeping malaise. The S&P fell by 50%, but it was spread. I think I had an internet problem there, but hopefully all okay now. So if we look at where we are now, if we accept that risk assets like property provided little, if any, diversification benefits in these previous crises, and we look at what that means for investors right now, if we can move on to the next slide, we'll see that the current crisis much more closely resembles the GFC, the global financial crisis, or it more closely resembles the COVID lockdown than the Y2K crisis. But it does have the added potential to become much more severe than the GFC or than the COVID lockdown, because of the fact that policymakers are allowing this downturn to continue. Previous crises stemmed from policy errors, and the ensuing rebounds came about through coordinated policy actions. But at the moment, we're not seeing any sign of those policy actions, and we don't know when we will. And that makes the future both unknown and unknowable. It depends entirely on unpredictable policymaker responses. We know that in the worst case, losses for equity markets can be over 90%, losses for property markets can be more than 80%. So, and when that happens, the correlation between property and stocks tends to be very high. They tend to move together. But precedent doesn't help us in terms of knowing when either or both will stop falling. But what we can see is that the current economic challenges are closer to the scale of the GFC, closer to the scale of the COVID crisis, much worse than the millennium crash. Relatively milder events at the turn of the millennium were met with stimulus that was on a larger scale than previously, but at least it was recognizable. 2008, when Treasury Secretary Timothy Geithner said that America was melting, and during the GFC, we saw policy responses of a totally different scale to anything we'd ever seen before. And the sharp fall in both property and in stocks suggests we might actually need some similar shock and awe if the current events are to pass reasonably quickly and not to take root. A simple monetary policy U-turn might not be sufficient anymore. But again, we won't know that for sure until afterwards. What we do know for sure is that other risk assets like property don't provide diversification to equity investments when we're in crises like today. Therefore, a superficial approach to diversification would agree or would support Friedman's superficial assertion that there isn't any such thing as a free lunch. But a deeper dive, if we can just show the final slide, a deeper dive would tell you that if DI does offer a free lunch, really we can only get that by a very careful study of the menu. And in that case, if we do understand how diversification works, we do understand how correlation works, we can mitigate some of these unknown and unknowable risks. But we really do have to study very, very carefully. Thanks everybody for listening. I'll now hand you all back to Kun Air in Thailand.
Thank you so much, Kun Paul. It was very fruitful and very interesting. Now I think we are moving to Emile de Marsac from Henley and Partners to talk about the diversifications in terms of the residence and nationality approach. The floor is yours now, Mr. Emile de Marsac.
Thank you very much, Kenneth. I'm just going to share my presentation with you. If you don't mind helping me to bring that up. But delighted to be here today for the webinar with MBMG Group. I'd like to just introduce myself. Initially, I'm a private client advisor at the Henley and Partners Bangkok office. And here's an introductory slide to Henley and Partners. We're the global leader in the investment migration space. We've been operating in this industry for over 25 years, and we now have 35 offices worldwide. We've advised over 20,000 clients on investment migration options, raising over 10 billion USD in foreign direct investment to the countries who actually run these residence and citizenship by investment programs. And we have over 30 different investment migration options available worldwide. And we've worked with 15 different governments, advising them on the design, implementation, and promotion of their residence and citizenship by investment programs. In terms of country-specific risks for investors and entrepreneurs, committing an entire portfolio of business interests and investments to one specific country puts an investor or an entrepreneur at far greater risk than a diversified strategy across multiple jurisdictions. For example, a restaurant owner who has all their operations and assets in one country will be severely impacted by a sudden tax rate hike or change in licensing regulations, a slump in the property market, or economic downturn, limiting customer spending power. If that restaurant group had operations and assets in other countries, then the revenue accrued from normal business elsewhere would help to counteract the loss of earnings. So these risks can be sudden and very difficult to anticipate. They can be prompted by failure of national governance, shifts in society, asset bubbles, war, pandemics, natural disasters, and climate change. So domicile diversification is a means of mitigating these risk factors. And it all centers around the concept of not putting all your eggs in one basket by ownership of multiple residencies and citizenships. So a diversified investment portfolio is less likely to be damaged by setbacks in any individual security, sector, asset class, country, or region. Global mobility opens up opportunities for families and individuals to pursue work and business opportunities around the world, while facilitating access to leading healthcare and education systems. It's an intergenerational legacy planning tool to future-proof your family now and for generations to come by providing optionality and a plan B. Holding multiple residencies and citizenships is an excellent insurance policy against political and economic upheaval and global disruptors. In recent times, volatility has been a global constant. And indeed, the world reached new heights of uncertainty with the ongoing war in Ukraine. Increasing numbers of individuals and families are recognizing the importance of domicile diversification to hedge against risk and safeguard their future. Domicile diversification, just moving across to the next slide. Domicile diversification also offers improved health security by providing access to leading healthcare facilities. During COVID-19, certain public healthcare systems were stretched beyond their limits. Holding alternative citizenships enables individuals to access alternative healthcare systems in other countries to receive timely treatment and, in some cases, vaccines. The qualifying investments for various citizenship and residence by investment programs include investments into real estate, stocks, bonds, and indeed funds. This provides a dual benefit of diversifying wealth portfolios and receipt of long-term residency or citizenship through a single investment. And many entrepreneurs around the world, they travel to attend meetings, conferences, seminars, and events. And visa-free access to a high number of countries will enable entrepreneurs to cut through the red tape of visa applications, which will help to improve efficiency as it saves significant time and hassle. And on this slide, we have a domicile diversification case study across multiple generations. And in this case, across 3 different generations. Investment migration offers solutions for large families who don't necessarily need to be in the same location. So in this particular example, the father is a successful tech entrepreneur, so he can apply for Australia's Global Talent Independent Program to obtain permanent residence there. Whereas the children have their sights set on studying in Europe or the US, so they can apply for the US EB-5 visa program to obtain green cards, which would enable them to then kickstart their careers by working in the US after graduation, or they could obtain a Portugal golden residence permit, which would allow them to reside long-term in Portugal and also provides a pathway to EU citizenship, at which stage they could then live, work, or study anywhere in the EU. The grandparents are retired and their priorities are different. They would like to focus on spending more time on the beach and in the sunshine. So they have opted for Thailand. And through the Time Elite Residence Program, they're able to reside in Thailand for as long as they wish without having to worry about visa renewals, and they can come and go freely. And so what are the main reasons for acquiring alternative residence? Well, there's several. Firstly, access to leading education systems. This is increasingly important in order to provide opportunities later in life. Quality of life. So it may be a case of moving to a country that offers more personal security, an improved healthcare system, and indeed a cleaner environment, as well as strong infrastructure and transportation systems. Also, moving residents can also have an impact upon taxation. So shifting your tax residency is a good way to look at mitigating tax burden and regulatory restrictions. So it's an important consideration for tax planning. From a security perspective, some countries offer little in the way of privacy and investment banking. So moving to an alternative residence that has more security and privacy in that area could be beneficial. And also moving to an alternative jurisdiction which has a stable political, economic, and legal environment also offers numerous benefits. And then equally, the reasons for acquiring alternative citizenship include visa waivers, as we touched on before, cutting through the red tape surrounding visa applications. Also retirement, so the freedom to retire in a country of your choosing without having to worry about updating your visa. You're able to remain in that country long-term for as long as you wish. Healthcare, access again to some of the top hospitals and clinics around the world. Also, in terms of mobility, the freedom of movement. This could be, for example, during a pandemic scenario. You may not be happy with the current jurisdiction you're residing in, and having alternative citizenship would enable you to expatriate to another country where perhaps you would be more comfortable. Also, in terms of climate, is an important consideration. Individuals obviously are concerned about issues such as pollution, and relocating to cleaner environments is an important consideration for many. And a few final reasons for acquiring alternative citizenship include tax planning. So citizenship is one of the tiebreaker rules for most double tax treaties. So it does play an important role from a tax planning perspective. Also, in terms of protection, there are many jurisdictions that offer significant privacy in banking and also physical security and less crime. Expatriation, as we touched upon again, in the event of pandemics or any requirement to relocate, that option is always available. Also, you can seek consular assistance from the country in question. And security, the right to reside in a permanent alternative destination for the remainder of your natural life, and therefore having a plan B and more optionality. I'd like to take you through some of the current trends in the investment migration industry. We've seen a significant uptick in interest from US citizens looking to acquire second citizenships as a hedge against changes in US fiscal policy moving forwards. This would give them the option of renouncing their US citizenship at some point in the future, should they wish to do so. We also see interest amongst British citizens in golden visas in the EU. That may be for retirement planning purposes or even for employment and business opportunities. So these golden visa programs provide greater access to countries in the EU and a pathway to citizenship, such as the programs in Portugal, Greece, Italy, Spain, and elsewhere. Also, in terms of health security, as a direct result of the COVID-19 pandemic, we see individuals from certain countries, in this case, for example, wealthy, high net worth people from India, looking for health security reasons to obtain alternative citizenship or residence so that they could take advantage of healthcare services in other countries. During the pandemic, some healthcare systems were stretched to their limits. And I think this is an important consideration in terms of being able to seek treatment elsewhere. Also, high net worth individuals are now increasingly looking at acquiring additional residencies and citizenships as a direct result of COVID, having essentially backup countries so they can relocate when they need to different jurisdictions. Perhaps they may approve of certain regulations and governance and approaches towards pandemics in certain jurisdictions. So it gives more optionality and the ability to relocate any time if you wish to do so. In terms of the growing investor base for investment migration, what we're seeing is that high net worth individuals are increasingly looking at investment migration options to protect their family's wealth and legacy during turbulent times. And we're seeing increased global volatility currently. So it's always good to have more optionality. We're seeing also individuals based in authoritarian countries investing in programs so they can protect their wealth. And indeed, they can relocate for personal security reasons should they need to at some point in the future. And also, leaders around the world are recognizing the importance as well of residence and citizenship by investment programs as a means of generating direct income to a country. An example would be Dominica. So the Dominica Citizenship by Investment Program accounted for 29% of the country's GDP in 2019. so making a very significant contribution to the country's economy. This is a quick snapshot of global residence and citizenship programs around the world. And there are some additional programs, but these are the programs that we offer assistance with. So spanning the globe right the way from Canada to Australia. And I'd like to go into a little bit more detail on some of these programs. So in Europe, there's various residence programs available. And I'd like to highlight the Portugal program here. So through a real estate investment of at least 280,000 euros, it's possible to obtain a 5-year residence permit for Portugal. And if you spend 7 days per year in the country, then after the 5 years has elapsed, you can apply directly for citizenship. And so this is a very attractive program. There's no government donation requirement. As soon as you receive the initial residence permit, you'll also be able to travel visa-free throughout the EU. So this is a very attractive program currently with very reasonable minimum stay requirements. Also, there are programs in Cyprus, Greece, Italy, and Malta. Greece has a similar program in place with a 250,000 euro requirement as an investment into real estate with a slightly longer pathway to citizenship, but that's another popular program. Malta, Italy, Cyprus, and Spain have other programs as well. And in terms of European citizenship programs, there's 4 countries that offer programs currently. Austria doesn't have a formalized program in place, but through discussions with the government, it is possible to obtain citizenship in return for either 3 million euro donation or an 8 million euro investment into public infrastructure projects and community projects in the country. Malta also has a citizenship program, Malta being an EU member country, an 18-month processing time for that program and a requirement for a donation of at least 600,000 euros to the government, but in receipt for a very strong passport, which has visa-free access to 185 countries globally. Montenegro has a program in place as well currently with an 8-month processing time. Montenegro is next in line for EU membership, which is tentatively expected in the next sort of 3 to 5 years. And that program has requirements of a 250,000 euro investment into real estate coupled with a 200,000 euro government donation. Turkey has a program in place as well, which is attractive because there's no government donation required. It's a straight $400,000 investment into real estate. And also a very quick processing time of as little as just a few months. There are various programs as well in the Caribbean. And these tend to be very popular because they're quick to process. There's no requirement to actually visit these countries to obtain the citizenship documentation or passports. And the entry requirements are reasonable in terms of either a $100,000 investment donation or alternatively a $200,000 investment in real estate. These are all Commonwealth countries, so they all have visa-free access to the EU, 6-month visa on arrival in the UK, and also visa-free travel to Singapore and Hong Kong. The Grenada passport also holds visa-free access to China and Russia. These are popular programs. The processing time as little as 2 to 6 months for these programs. As well as, I would also add that these countries are all very favorable tax jurisdictions as well. And the US has an EB-5 visa program in place, which offers green cards to successful applicants. So through an 800,000 USD investment into a community project that creates 10 jobs for US citizens, it's possible to obtain green cards through this program for the main applicant and qualifying family members. There's a requirement to hold the investment for at least 5 years. And the way the program works is that an applicant would initially seek out pre-approval. Upon receipt of that, they would receive a 2-year conditional green card, which will allow them to live, work, study. It has the same benefits as a permanent green card. And then they'd have a 2-year period to fulfill the investment requirement, after which they'll receive a permanent green card for the US. So this is a great option for parents who are looking to send their children to study in the US, because upon completion of their studies and graduation, the children will then have a green card in hand, which will enable them to kickstart their careers and work in the US. The UAE has a golden visa program in place as well. The UAE is expecting a net inflow of 4,000 millionaires this year, largely due to the excellent infrastructure, low taxation, crypto-friendly regulations, and also in part due to the programs that they've now put in place around residency. So through investments into real estate or public projects, or indeed for individuals with specialized talents, it's possible to obtain a 5 to 10 year residency visa for the UAE. So this is growing in popularity as the UAE establishes itself as a very strong business hub. And finally, there's global talent migration programs in Australia and the UK. There's no investment requirement for these programs. Essentially, the governments are seeking to plug gaps in their economy by attracting individuals with certain skill sets in certain sectors. And so for individuals who are prominent and have extensive experience in their fields, this is a great option because these governments will issue 5-year visas. It's possible to work and also open a business on these visas. And they both have pathways to permanent residency and citizenship as well. So that's it from me. And I'd like to hand back to Kun Air.
Hi, yes. Thank you so much, Emile. Relocation for a better future or to improve the quality of life seems to be the trend right now. It's certain that it needs good and thorough planning, not just visa-wise, but also on taxation, security, health insurance, education, etc. It will be based if anyone interested in relocation could just plan it through with experts like Henry and Partners. Thank you so much, Emile.
You're welcome.
And now we are giving our spotlight to James, who will update us on cross-border reporting and exchange of information, particularly on the measures affecting us here in Thailand. But just a reminder to our audience, if any question, please feel free to leave your comments down below. We get back to that on Q&A session.
Hi, hello everyone. Hi, thanks thanks for the introduction. Hello everyone. And thanks for waiting to the end. I hope you can hear me okay. If you can't hear me or anything, let me know through the comment section. Let me just try to get my slides up here. I did manage it before. What am I doing wrong there? Oh, there we are. There it is. Okay, so today I'm going to talk about the common reporting standards, which I'm sure you've all heard about for a number of years now. This actually concerns two types of information exchange. The exchange of information on request, which is when a country's authorities, such as the revenue department or the government, can exchange for information over the last 5 years. And then the important one, which people worry about, is the automatic exchange of information. This focuses on end-year bank accounts. Over 130 countries have joined, including the tax havens such as Seychelles, Vanuatu, and Mauritius, BVI, several actually, pretty much everyone, the Isle of Man, as well as all the European OECD members, almost all of Asia as well, Hong Kong, Singapore, pretty much. It's really mostly all the developed countries there already joined this. So it's going to be really difficult to escape as each year goes by. And what about Thailand? Well, surprise, surprise. Thailand is actually doing the CRS for this year. It's already started. As you may have heard in the newspapers, Thailand ratified the Personal Data Act in 2019. It was delayed due to COVID here in Thailand. It was delayed for 2 years, so it wasn't implemented until 2021 last year. So now, many businesses are scurrying around trying to make sure they're fully adapted to this Personal Data Act, which protects the privacy of people's, financial data. This is part of the OECD condition for joining CRS, in that they have to be able to protect people's data because they're obviously sending it cross-border. And then Thailand was forced really to sign up to the exchange of information. This is like the automatic exchange at the end of last year when they ratified the MAC, which is basically a mutual administrative assistance agreement on tax. So this is the agreement they need that preludes the going ahead of CRS. So banks will begin collecting data on the 1st of January. So if you close a bank account in Singapore or wherever you may have one during this year, in theory, it should get reported back to Thailand by the end of next June. So Thailand will report its information of non-residents living in Thailand by the 30th of September. Normally, it should be the end of June for the previous calendar year. But because it's Thailand's first year, they give an extra 3 months. So these would principally be the bank account balances, bank closures at the end of each calendar year. They will also provide a lot of information, which I'll let you know at the end, such as, the tax number and things. And this is the type of accounts that are affected. So as you know, bank accounts, investment accounts, such as if you have broker accounts, loan accounts, life insurances, and also trusts and holding companies. But we don't know where they're going with those. I mean, this is the controlling aspect. If you control a holding company that invests in passive investments, in theory, it's supposed to also be reported if you are, the major, the controller of that. But it really depends who you have it with, or even if you have set up that company by yourself. I wouldn't say loophole, but perhaps, but what they haven't managed to close the gap on yet is how to enforce, people that have set up their own companies to actually report themselves. And I think it's going to be quite difficult. So, and this goes for trusts as well, and there are ways around that. So essentially, when people talk about CRS, they do only talk about bank accounts at this time. So what will Thailand receive then? Well, as I said, it's going to receive this basic information on overseas financial accounts. And let's put a question mark around that, controlling stakes in passive non-financial entities for now. It just really depends who you have it with. So these are going to be held by Thai residents, Thai tax residents, that is, that are non-resident in another jurisdiction. So if you're, in Hong Kong or wherever it might be, the BVI, and you have a bank account there, right? We're looking at bank balances. So, that's going to be reported back to Thailand, and it's supposed to show up on your file. So, for example, when I went to file my personal income tax in March for last year, they key my name in and my number, and they actually can see the withholding tax that has been paid by MBMG, and they saw that I changed to work to MBMG Solutions now, where I was in the investment advisory department before, and they were talking to me about which company had paid what up until the end of the year. So they have this file where they can see what's being paid, and it should show up eventually. I'm not saying that it will show up immediately, because it might have teething problems, but OECD provide a software to the revenue department that actually can help them. If they install that, it's supposed to filter down the information to the names of the individuals and the entities as well. So these are, besides the bank account, so let's go a little bit more. So a controlling person of a passive non-financial entity account or a trust. So this is basically beneficial owner, the ultimate beneficial owner, which, these financial institutions need to report who is the ultimate beneficial owner. So if you have an account, a private investment, a wealth account, and maybe it's used under a different name and not like we might say a nominee name, or it's under the investment house's name, as you see many times, they still have to report who is the ultimate beneficial owner to the authority of that country, or normally always the revenue department. So therefore, that includes custodial accounts and trusts. Trusts are supposed to include the settlor, the beneficiary. Right now, it seems to be only the controller that is reported. But in the future, their legislation, they plan, if you read their handbook, is that they need to also look at settlor beneficiary and how that might be. Of course, but they do actually get information on money leaving the account, but and going into a trust account, but they just might not know where that money is going after it's left, or a beneficiary will receive money. they will see the end bank balance increasing, but they don't have the details necessarily on the trust. So, holding companies, we some of them will have to report depending on your financial institution. So if you have trust or an account with a financial institution that's been heavily fined in the past, let's say HSBC, you might find that they feel more compliant to follow the rules strictly rather than to give waivers or to set up some kind of structure that might be able to get around that. So who is at risk of these things? Well, if you've opened up accounts in CRS compliant jurisdictions, which is just about every offshore place, or even a non-compliant one that is expected to join. So they are also keeping your data, and some of that data can go back since the beginning of CRS and can be kept actually up to 10 years, not just 5 years. This is actually called the wider approach, and I might talk a bit more later, but the wider approach is where they simply collect everyone's information, and as long as they've passed, the correct legislation for being able to keep that data, and they collect all that information, and then it saves them money, to get it all going once they join CRS. So they do actually have the money there. They do actually have the details there. My slides have disappeared. There we are. So, and also, so obviously for a corporate or another type of financial entities, so they're looking at the signatories of the people that open the bank for these type of entities. Those are the people that will be on the CRS. So what will be reported under CRS? So what can you do now? So one thing we've always been recommending over the last actually 5 years since we've known that Thailand will join, because Thailand's been a bit slow, and I could say they've perhaps been trying to avoid it or leave it to the last moment, but they have been joining all these committee members, and they agreed to do the information on request since 2018. So we've been advising people close unnecessary overseas bank accounts. We have several clients that walk in that have some bank account somewhere, and they hardly ever use it, or they've stopped using it a long ago, but they've just never closed it. So it's better to just close these things that you don't need anymore. Look at your feasibility to have a resident shareholder where it's legally viable, such as in Singapore or Hong Kong, or I think there's other jurisdictions, even the Isle of Man. I think there's several offshore jurisdictions that will actually provide a resident shareholder for you, and a resident director even. For the time being, that seems to get around the issue, but strictly speaking, they're not really reporting to the authorities the ultimate beneficial owner, or they're very unlikely to. And certainly that's something that you need to check before you pay money to these service providers that do that, because it's a bit of a waste of time if they still end up reporting you. And if you do have money offshore, I mean, it's actually not necessarily illegal, but you have to make sure that you follow the correct rules regarding transferring the money into Thailand if you are a Thai resident and living here, because there's actually a reasonably easy way to get around that. You just bring the money in the following calendar year, what you earned this year. But the problem is for that you need to understand is the Thai Revenue Department doesn't work on either first in, first out, or last in, last out basis. So basically you really have to put that money from the previous year that you want to transfer into Thailand into another account, and don't really, when it comes to the new year, you don't add any more. Or alternatively, you just bring the money in on the very first working day of the next calendar year, if you can remember to do that. And then that should help to provide evidence that it is really money earned last year, and it wasn't money that you earned yesterday. So you could consider a hybrid trust. A hybrid trust structure is really, though, needs a minimum of probably 10 million. Every time I talk about this, the number seems to go up. I mean, it used to be 5, and now it just seems to be 10 pretty much everywhere. Otherwise, the fees get quite high. The hybrid structure is basically you have a committee that's a controlling aspect of the trust, but the committee actually consists mostly of the decision maker, of the settler. So it's like a living trust, but it's actually done in an informal way. So it's not, there's no official language in the trust contract that says you are the controller. So there is also a risk in that, in theory, under the contract, you're actually not the controller. So you have to trust the service provider, which is usually a large financial institution. So that's, or you can ask MBMG for a CRS health checkup. We do these checkups. We provide, advice CRS wise on a structure that you might have. That's just going on about the wider approach I looked at, and this is the details, TIN number, account number. This is the details that you have to provide and what's provided to the tax department. That's the end of my presentation, and I think I've come in just before 4 o'clock. I hope that we still have questions about this. Time for questions. Please ask your questions now.
Yes, I always do have time for questions. Thank you so much, James.
Thanks.
And actually, we have got 2 questions already in our comment section. Okay, the first one is about the citizenship. So I think Emile is the best one who answered that. The question is from, I'm sorry if I pronounced it wrong, Miss Muifa. I am interested to apply for additional citizen for my kids' education in UK, which is the best way to start with.
Thank you for the question. So essentially, there are a couple of pathways to indefinite leave to remain or permanent residency and citizenship in the UK. One of them I did outline during the presentation, which is a global talent visa, which is aimed at people in certain sectors who are well established and prominent and industry leaders. And that program offers a 5-year visa for the UK. It's possible to work, open a business on that visa, and it does offer a pathway to citizenship. So initially, the first step would be after relocation to the UK, and a further 3 years in the UK, it's possible to apply for indefinite leave to remain through that program, and then a later stage citizenship. There's also another program which is called the Innovator Visa in the UK. And that requires an investment at least £50,000 into a business, which could be a new business or an existing business in the UK, but it has to be have a creative element to it. It has to be something that the UK government deems to be innovative and different in nature. That program again offers long-term residency, and permanent residency is possible after 3 years through that program. And then citizenship is an option later on. And finally, through the Caribbean citizenship programs, which are all Commonwealth countries, there is some possibility to actually receive scholarships for higher education in the UK at certain institutions. But that would require sort of consultation really with an education expert. But I'd be happy to discuss it further over a call.
Okay, thank you so much, Emile. I think the best way to get it started is to talk to Henry and Partners then.
Absolutely. Thank you.
Okay, come to the next question. I think this one goes to James or Paul. If I have investment and accounts overseas, the Thai authorities will know all about these, but right now they don't know about them. Is that correct?
Yes. I mean, they don't know right now, but they will know about your bank accounts and your investment accounts quite possibly by this time or by the end of September next year. In theory, they should. I mean, providing the software all works well and everything goes as planned, yes, they will know what you had at the end of December 2022 and what accounts you closed during this year and what the end balance was. That's right. And your other question there I see is, will it also include the case if the authorized signatory and or director of a Thai company bank account is a foreigner? Well, the signatory, I mean, it depends. The foreigner is a Thai resident. If he's a Thai resident and he's in a, opened an account for investment in a or for just a bank account in a non-resident country, where he's non-resident, such as Singapore, then yes, he'll be reported here. And director, if he signs the entity bank account, yes, and that account, and the entity is Thai resident, and he's got the account offshore, then yes, that will be reported back to Thailand. That's correct.
Yeah, I think that's the key point, isn't it, Jim? That this is all done on tax residence, and the banks have to compile the tax identification numbers of all the account holders or signatories, and if the tax identification number indicates that the signatory or the account holder is Thai resident, then any other compliant jurisdiction will automatically report that to Thailand. But also there's this provision that you mentioned for the Thai authorities then to be able to request additional information, isn't there?
Yeah, if they are suspicious. But I think it would be quite rare, that they would do that, because I have a feeling it's just data filing, But if they have software that can kick up things that might look incorrect, like the Thai brokers do, they can pick out stocks that are being manipulated because the software is geared to do that. If they have some software that can do that, then that might be what goes on. But otherwise, I think going back 5 years would probably only concern people that had problems already, Yeah. Any other questions? We'd love to have some more questions. I don't think we're getting kicked off at 4 o'clock.
No, we just have a thank you note from Daniel Parents. Thank you, MBMG and Henry Partners. Excellent information. Thank you to you too, Daniel. I think that will be it for today.
Well,
so thank you very much
for hosting this. Yeah. Thanks for hosting, Kunal. Thanks for joining. And,
I would like to thank our audiences as well. For joining our webinar today. It was very insightful and very informative. It was fruitful. And I don't doubt that if any of our audience had any question, they can feel free to reach out to Henry and Partners or our MBMG Group.
Well, thank you, Kunal. Thank you, everybody. Khop khun krap.
Yeah, thanks to everyone.
Thanks for today. Thank you so much.
Joining as well. Thanks, Emile, for helping us out with this.
Thank you very much. Yes, it's been a pleasure. Thank you.
Bye.